Hey there, I'm Dylan Lewis from The Motley Fool. In this FAQ video, we're going to explain dividend yield, how investors can use the dividend yield formula, and at the end of the video, we're going to go through a nightmare scenario of how investors can be tricked by a high yield stock. Dividend yield is a metric all dividend investors obsess over. It refers to a stock's annual dividend payments to shareholders expressed as a percentage of the stock's current price. Now, the actual formula is annual dividend payments divided by stock price. For example, as of taping, Microsoft shares cost around $167, and the company pays a quarterly dividend of 51 cents. If the dividend stays exactly the same, over the next 12 months, investors will receive 4 dividend payments totaling $2.04. Dividing that payment total by the current share price, you get a yield of around 1.2%. Another way of thinking about dividend yield is that 1 year from now, if shares of Microsoft are exactly the same price they are now, investors will have gained 1.2% thanks to the dividend payments. Now, it's important to realize that a stock's dividend yield can change over time, either in response to market fluctuations or as a result of the dividend increases or decreases by a company. In the case of Microsoft, for years, investors enjoyed a yield of over 2% on their shares. But over the past 2 years, the company's stock price has almost doubled thanks to its booming cloud business. So even though the company has increased its dividend every year for the past couple years, the yield is near 10-year lows because the share price has gone up faster than the dividend payments. That's why it's important to understand the underlying equation for calculating yield, and why it's important to consider yield and total return. Dividends are just one component of how investors can make money. You should also look at this total return figure, which takes dividend yield and includes increases or decreases in share price too. For example, if a stock's price goes up by 5% this year and it pays a 3% dividend yield, then your total return is 8%. In the case of Microsoft, in the beginning of 2019, the yield was roughly 1.5%, but over the course of the year, shares went up 55%, giving investors that bought on January 1st, 2019, around 56% returns. Pretty darn good. With Microsoft, yield went down because shares became more valuable. The opposite can happen too. A stock's dividend yield can go up dramatically because a company's share price falls. Say shares of a stock go from $20 to $10 over the course of a year, and its dividend of $1 stays exactly the same. The company's yield would go from 5% to 10%, and it would seem like an awesome opportunity for investors that haven't been following the company closely. If they're blinded by the yield, they won't realize that it's only high because the business is struggling, and if it continues to do poorly, the company might cut its dividend entirely, and investors could lose even more if the share price continues to fall due to bad business results. That's why, in addition to looking at yield, you should look at the company overall. Here's a quick list of things to keep in mind. Do you understand the business? Can you explain what they do and how they make money? If you can, you'll be able to recognize and understand the business and how it's doing financially. 2, is the company growing? Is the company posting revenue growth, and is that growth generally in line with where it has been in the past? A growing business is more likely to be a healthy business. And 3, is the business relevant in its industry? This is harder to measure, but the idea here is that you generally want to own market-leading companies or companies poised to become market leaders. If an old business is in the process of being disrupted, it probably doesn't make for a great dividend stock. One way to think about a lot of these factors and look at it in one digestible metric is to look at a company's payout ratio. This measures how much a business pays in dividends relative to its net income. The reason we look at this is that dividend payments are something a company elects to do, and if they're struggling, they might decide to cut their dividends. There isn't a single right figure for the dividend payout ratio, but the idea here is that you want to look at the number relative to where it has been in the past for the company and how the company compares to its peers. If the ratio suddenly spikes unexpectedly, that could be a sign that the company might have trouble maintaining its payments down the road unless it's able to bring in more money with its operations. And if a stock's payout ratio is over 100%, it means the company is paying out more in dividends than it's making in income, which is not sustainable over the long term. For a full breakdown on dividend yield and payout ratio, get our free dividend report over at fool.com/payme. There's a link for that down in the description. One last thing on dividend yields. There are special structure businesses like real estate investment trusts and master limited partnerships that operate slightly differently than your average business. They have higher yields because they are built to share more of their income with their shareholders. Now, there are great REIT and MLP investments out there, but they require using industry-specific metrics to evaluate. We'll drop a link to our REIT video in the comment section. The point is, investors looking at only yield might accidentally buy MLPs and REITs without realizing it, and that could open them up to complex businesses and complicated tax structures. That's why item number 1 on our checklist before was, do you understand the business? Make sure you do your homework first and don't just scoop up shares of high-yield stocks. Okay, that's gonna do it for this FAQ video. We wanna know what you want us to cover next. Drop ideas down in the comments section below. And if you could do a favor and hit the thumbs up button below to like the video, it tells YouTube that we're doing good stuff over here and it helps us reach more people. We love doing that. If you want our free dividend investing playbook, head over to fool.com/payme. It's got everything you need to get started and 3 starter stocks. Microsoft is one of them. You have to head to the link to get the other 2. Until next time, thanks for watching and Fool on.